Most beginners do not lose money because they are stupid. They lose money because Wall Street sells them a story before they understand the game. A stock is not a lottery ticket. A stock is not a team jersey. And a stock is definitely not good just because the company is famous. The first rule of market survival is simple. A good company can still be a terrible investment if the price already assumes perfection. That one sentence can save a beginner years of pain. If you are new to investing, you are entering a market designed by professionals, marketed by influencers, and emotionally powered by crowds. That does not mean you cannot win. It means you need to understand what game you are actually playing. Most beginners think the question is this a good company? That is the wrong first question. The better question is, what expectations are already built into this price? Because in the stock market, you do not get paid for buying a company everyone already loves at any price. You get paid when reality turns out better than what the market expected, or when you avoid paying for fantasies that never arrive. Let's make this simple. Imagine a restaurant in your town. The food is excellent. The place is always packed. Everyone knows the owner is talented. Now imagine someone offers to sell you that restaurant for $1 billion. Is it still a good business? Maybe. Is it a good investment at that price? Probably not. That is the difference beginners miss. A company can be real, the product can be good, the CEO can be impressive, the future can even be bright. But if the stock price already assumes explosive growth, perfect margins, no competition, no recession, and no execution mistakes, then you are not buying opportunity, you are buying pressure. And pressure is what crushes beginners. Wall Street understands this. Financial media understands this. Promoters understand this. They rarely sell you valuation first. They sell you narrative. They say things like, this company is changing the world. This is the future. Institutions are loading up. You do not want to miss this. Notice what those phrases do. They do not help you measure risk. They trigger fear of missing out. And fear of missing out is one of the most expensive emotions in the market. When beginners chase a hot stock, they usually enter after the easy money has already been made. By the time the story reaches social media, the chart often already reflects months or years of optimism. That does not mean the stock must crash. It means the beginner is late to the expectation cycle. And being late changes the risk. Here's a cleaner way to think. Every stock has two parts. First, the business. Second, the expectations attached to the business. The business is what the company actually does. Revenue, profits, assets, debt, cash flow, competition, and industry structure. The expectations are what investors believe will happen next. Beginners focus almost entirely on the business story. Professionals focus heavily on the gap between price and reality. That gap is where risk and opportunity live. If a bad company is priced like trash, it may not need much good news to rise. If a great company is priced like a miracle, even good news may not be enough. That is why stocks sometimes fall after good earnings. The news was good, but the expectations were higher. The beginner says, I do not understand. The company beat earnings. The market says, not enough. This is why you need a pre-buy checklist before you ever touch the buy button. Not a complicated one, a survival checklist. Question 1. Do I understand how this company actually makes money? If you cannot explain the business in plain English, you are not investing. You are outsourcing your judgment to a story. Question 2. What has to go right for this stock to work from today's price? Not from last year's price. Not from the price your favorite influencer bought it. From today's price. Question 3. What could make the story fail? Competition, debt, regulation, margin pressure, slowing growth, a recession, a funding problem, customer concentration, management overpromising. If you cannot name the bear case, you do not understand the bull case. Question 4. Am I buying because of analysis or because I feel left behind? Be honest. The market punishes emotional urgency. Question 5. How much can I lose if I'm wrong? Not how much can I make if the dream comes true. How much can I lose if the crowd changes its mind? That is risk, and risk comes first. The beginner wants certainty. The market offers probabilities. The beginner wants a stock pick. The market rewards process. The beginner asks, what should I buy? The better question is, what would make this investment wrong? That shift is the beginning of real investing. You don't need to predict every move. You need to stop making obvious beginner mistakes. Do not confuse a product you like with a stock you should buy. Do not confuse a famous brand with a cheap valuation. Do not confuse a rising chart with low risk. Do not confuse confidence on YouTube with competence. And do not confuse a story with an investment case. Your first goal is not to get rich fast. Your first goal is to survive long enough to get good. Because the market is not going anywhere. There will always be another stock, another cycle, another panic, another bubble, another opportunity. But if you blow up early because you chase stories without understanding price, you will not be around when the real opportunities show up. So remember the rule: a good company can still be a bad investment. Price matters, expectations matter, risk matters, and if someone is trying to make you feel stupid for asking basic questions, they are probably selling you something. Beginner investing is not about sounding smart, it is about avoiding dumb losses. Start there. If you want clear investing lessons without hype, stock pick bait, or guru fantasy, subscribe. This channel is not here to sell dreams. It is here to teach market survival. This content is for education only. It is not financial advice, investment advice, or a recommendation to buy or sell any security. Always do your own research, and consider speaking with a qualified financial professional before making investment decisions.